The basic concept of transaction. The atom of activity of the firm is the transaction. Most usually it is an exchange between the firm and the rest of the world. The life of a firm is a long list of transactions recorded first of all in the journal. Of course, the firm does other things, like for example hiring people, and that is not a transaction recorded into the journal. From now on, for our learning of accounting, the firm under consideration will be a shop selling products with no physical transformation. The value added by the shop will be selecting the products, transporting them, warehousing them perhaps, displaying them nicely in the shop, assisting the clients, etc. But there will be no physical transformation. At the end of this accounting course, we shall study the slight changes to be made in order to account for a manufacturing process. Depending upon countries, the legal structure of this shop can vary a bit. In the Anglo-Saxon world, we shall look mostly at what's called a sole proprietorship, that is a guy or a lady owning a store shop. And we shall make a big distinction between the owners and the managers. And in a sole proprietorship, it may be the same person. In France, for instance, the standard legal structures are the EURL or the SARL. So the activity of a small shop consists in buying goods, various equipments and work, the shop workforce, salaried people, and selling the goods at a higher price, of course, than their, first of all, acquisition cost, but even their so-called full cost. That is a topic for cost accounting. The difference is the profit, which is viewed as a remuneration of the capital, that is a remuneration of the owners who put some initial money into the firm. Most transactions are simple, and some of them will be a bit less obvious. Here are some examples of simple transactions. What we've called capital expenditures, that is spending money to acquire assets. Current expenditures, spending money to buy things or services that will be consumed quickly. Borrowings, we shall see in a minute what it is, are also simple. And there are some less obvious transactions. For example, receiving the initial capital, also something called amortization that we shall study, and the sales. The sales are a bit less obvious than a simple transaction. We shall see why. The basic representation of a transaction, we have already seen that many times, is this. You have the firm on one side, the rest of the world that are represented on the other side. Some value comes in and some value leaves, and the two values must have the same monetary measurement. And there is no exception to this rule here. No exceptions. The two values must have the same monetary measurement. That's a rule in double entry accounting. Example of capital expenditures. For example, buying a machine on credit. Well, the firm receives a machine at some date, and at the same date gives to the supplier of the machine that belongs to the rest of the world an IOU that is promised to pay at some point. Another example, buying some financial securities and paying cash, for instance. A firm can very well buy financial securities, that is stocks or bonds or something else. Well, in that case, the firm receives the financial securities and gives cash to whoever sold these financial securities. Examples of current expenditures. Well, paying the electricity, say cash. Well, for example, the firm over the past 2 months consumed electricity and pays the electric utility company some cash at some point. That's an exchange, that's a transaction which is viewed as happening at the same time, which is not quite correct. Secondly, paying salaries, cash. Suppose we pay them cash. Well, for the past month, the firm consumed the work of the employees, the salaried people, and at the end of every month pays them cash or with a check. And for the time being, I will not make a difference between cash and money at the bank. It's a slight refinement that we shall see in due time. Example of borrowing. The firm may borrow, for example, 100,000 euros from a bank. Well, in that case, at some date, the firm receives 100,000 euros and at the same date gives to the bank a loan contract signed by both, and the loan will have to be reimbursed according to a schedule over several years perhaps. And also, that is important to notice, this loan will cost yearly interest, and these are not part of the reimbursing of the loan. They are current expenditures on top of the schedule of capital refunding. So when a firm makes a loan from a bank, it has first to pay back the loan, and also it has to pay current expenditures for the use of the money. Let's turn to less obvious transactions. First of all, the initial capital, also called the founding capital. Suppose it was 1 million euros. Well, at some point, at the beginning of the life of the firm receives from owners, also called shareholders, 1 million euros, and the firm gives these owners or shareholders some pieces of paper, some sort of contract called shares. And these shares are not to be refunded in the future, usually, but shareholders, over the course of the years, may receive yearly dividends from the firm, and these will be some other types of expenditures. Another non-obvious transaction is the so-called amortization. We shall study that in due time, but just mention that right now. Machines and many other capital assets, but not land, wear out. In that case, we shall construct special types of transactions. The firm will consume part of the assets every year, and at the same time, these parts of the assets will leave the firm. So it's a less obvious type of transaction. It's not important that you understand it perfectly right now. Just be aware that amortization is treated as a transaction and is less obvious than just buying a van, for instance. And finally, sales. Here the problem is this. Since we want to apply strictly the rule, what's leaving equal in monetary terms, what's coming, and obviously when we sell something, what comes in, money, must have a higher value than what leaves, some goods, Italian merchants created an astute special account, actually two. Here's what they did. A sale will be represented like this. It's a transaction where money, perhaps an IOU, comes in. Let's say that we sell something for 100 euros. And what leaves the firm is something special, abstract. It's not the goods. We record sales of 100 euros. And at the same time, what actually leaves the firm is goods. Suppose they are actually worth 40 euros. So goods, that there will be another transaction at the same time, and compensating these goods leaving the firm, we shall record COGS, cost of goods sold, 40 euros entering the firm. You don't have to understand well that right now. We shall there again study that in some subsequent lessons. Just be aware that sales are not a standard transaction, even though they are the most important transaction in the firm, of course.